All right, welcome everybody to another Pepperstone Learn It Live event here where we master the markets and we discuss topics that you guys need to understand. Today, we're covering a very important one that I'm sure everybody loves out there, which is, of course, mastering price action trading, naked analysis, one of my favorite topics. And I would probably say, Tyrone, one of the best topics out there when it comes to understanding markets and price action. It's just so important we get those types of things under our belt, and that really, if we understand price action, we have the beginning of a great confluence system, don't we?
It is, Tom, and yeah, welcome everybody. Look, price action is often underestimated, but really it is the true leading indicator that no one talks about. I mean, people talk about trying to get an edge with indicators, but the only real leading indicator is actually price, and naked price action really exemplifies what that actually is. So yeah, looking forward to getting into today because we're going to cover a lot of very, very important topics.
Yeah, so what we'll be covering today is, of course, we'll be looking at comprehensive understanding of price action trading techniques from an advanced level, which will have some little secrets in it that I think you'll enjoy. We'll be also looking at identifying some price patterns, how you may have been looking at markets wrong if you've been scalping, day trading, or even swing trading without this technique. And of course, we'll also be looking at some practical strategies at the end of today's session. So stick around, or if you're watching this in replay, even fast forward into the end, and you'll be able to see some of the live application of how we might break down a chart, which I think is really cool. As always, we've got Q&A, so make sure to ask your questions and then we'll answer them throughout the session. We will hold back quite a few questions till the end, so make sure to stick around for that. And yeah, I'm looking forward to getting into it. We've got a quick disclaimer and then we'll get started. Okay, so Tyrone, I always get asked the same question, and it has to be, how do we better understand why price movements occur? And more importantly, is there an edge that we can gain from doing proper price action analysis? So today we're going to cover the 3 laws of Wyckoff, how to understand market price better, and then, of course, the composite man. What is it and how can it help you? One of my favorite topics. I know you love Wyckoff as well. Is the man, isn't he? And of course, he came up with this great quote here that we all love very much.
It is, yeah. Successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. And really, when you think about that, and yeah, in today's markets, it actually really highlights what you actually need to do. And when you do see market action actually moving in a direction, you have to have that confidence to actually believe that's what the market is going. A lot of people spend so much time actually fighting what the market's actually doing, Tom, don't they? That they actually really miss the important actually elements of what the market actually is truly trying to do.
Yeah, sometimes they say, Tyrone, that simplicity is the best understanding. And really, in this quote, we understand a lot about the market, but we don't just know it yet. So let's take a look together at what the 3 laws of Wyckoff were actually. The first one is the law of supply and demand. Now, most of us are aware of this. If you've done schooling or education or college or whatever those types of things, we all learn about the ideas of demand and supply. Basically, if demand outstrips supply, prices will rise. There's just a lot of demand out there, Tyra, and everyone wants it. We've seen this in markets around the world, in crypto, and many times. We've also seen it, of course, in collectibles markets, such as watches over the last couple of years, and high luxury goods. The demand was so much that they were selling for more than the recommended retail prices, sometimes in 300 or even 400% times that amount. It seems unbelievable since they've started to drop recently. Then we have demand is less than supply, and of course, price will drop. Nothing new there. Again, just an amazing concept. And then we have the one that I always like to think about, demand equaling supply. And this means there's no significant price change and there's lower volatility. Now, Tyrone, that actually turns into, and the demand equals supply actually forms a pattern, doesn't it, in price action analysis? And what is that pattern and how important is it for us to understand when markets are in this type of area?
Absolutely. That's where we're going to see markets consolidating. And really, that's the opportunity to actually sometimes get in if you have actually missed out. And I think sometimes people try to jump on a train after it's left the station. You hear that quite often, and people try to do that. Understanding when supply is equaling demand is a very, very important concept, because this is the area where you can actually get in and join in either into a very existing trend or what may be the next move out. This is actually the area where ideally in a perfect world you are getting in, whether it's a swing trade, long-term trade, or even a day trade. these are the ones that you have to identify. But probably identifying these without knowing the tricks of the trade can be quite difficult. So yeah, we're going to certainly highlight some of these tips today.
Yeah, so really, when we're talking about the supply and demand side of things, what's happened is the market's come down, demand and supply are kind of in harmony, what we call equilibrium. And then often what will happen is after the market is sat for a level, a lot of people will think, well, that means it's going to bounce up and move up back to the previous price. That's not always the case. A lot of the time, what will actually happen is it will consolidate. And what it's doing in this consolidation of demand equaling supply is often resetting the oscillators and the indicators. So a little bit of information out of today's video would be, remember, when markets start to range bound, what they'll actually be doing is resetting indicators out there. And that's very important. Now, the next law was the law of cause and effect. And what this showed us was that it basically shows that there was a difference between supply and demand, and they are not random. And instead, they came after periods of what we call market preparation. In Wyckoff's terms, a period of accumulation, which was the cause, can lead to an upward trend movement or the effect, and vice versa for distribution. To better understand this, Ty, if we go back to just the screen here, we can basically have a look at what this might look like. And we'll come back on the screen and basically we will show you what this may look like. The first thing is markets could come down and then they would effectively build a position, or they would equal demand equals supply. That was the preparation component. When the market breaks out of one of these coils, it is effectively the effect of that preparation. And once we understand there is a breakout of either direction, we are able to understand what this was. Was it demand or was it supply? If it breaks to the downside, it is what we call supply. If it breaks to the upside, it's what we call demand. And that means that if markets come back to that level in the future, there could be a very nice trade for us. And this is because the markets are prepared in these positions, a very large order. That order breaks out eventually. And then at that point, we know that if we've been patient enough, we can react to that particular position, can't we, Tyrone?
Yeah, most definitely. And patience is the key there, Tom. Once you do understand what you're looking for, you do have to be patient enough to actually wait for that trade to happen. You certainly don't want to be preempting where it's going to go, because quite often the first move is actually not the right one, and you really want to wait and be patient. We say it all the time, but it's really, really important, isn't it? Because if you do wait, more often than not, you're going to get, not only are you going to get the trade in, but you're going to get it at a far better level. You might say, well, if we got the break and it came back and tested it, went again anyway, we're still in. But realistically, you've had to endure a lot of what could be potentially market pain and potentially stop losses being taken out as well in that process. Patience is always going to help you when you're trading.
So then there's the last one here of his three laws, Ty, which was Wyckoff's third law stated that a change in instrument's price were a result of an effort generally represented by trading volume. Now, volume is one of the best indicators in the markets, whether you're trading stocks, whether you're trading cryptos, whether you're trading even commodities or even currencies, volume can be an essential tool. So let's say a crypto such as Bitcoin started to consolidate with a very high volume after a long bearish trend. This high volume could signify a big effort. The move would be sideways, similar to what we've been talking about before, and low in volatility, but it would suggest that transactions were high and a reversal could be near. So an example of this would be, of course, that the markets come down to a price, that we see a huge build of a position, then it breaks to the upside. We now know that's demand. And what's been happening through this is as it came down, volume was high, but it remained high through the entire build process. So basically, volume looked like this the whole way through. So the law of effort was coming through. Such an important one and often underutilized, isn't it, Tyrone? I think that is the biggest thing that I often take away from Wyckoff's three laws.
Yeah, it is. And I think that it's probably an underestimated tool volume. I know a lot of people say that it can sometimes be irrelevant if it's not really the correct volume. But when you actually see and you're dealing with a proper volume indicator, you know that you are actually getting that consolidation. And sometimes it can be very deceiving. If you're in a very low volume environment, the market can be actually quite volatile and tricky. So you actually want to see that. It is really ideal to actually see that volume build up and know that it's actually holding its own. Every candle or every bar that you're looking looking at has the same or similar volume than the previous one. So, there's actually activity there. It's not just a flat market where nobody is interested. I think that's probably the key to it, really, having a market that people are actually trading, even though it's not moving aggressively in either direction. There is a lot of market movement there, and that's actually confirming the area.
Yeah, liquidity. Absolutely. Liquidity is being present in the market. Now we go to the most misunderstood, I would say, composite man, the way that Wyckoff made us understand markets a little bit easier. So everyone always asks, well, where are the biggest traders in the market? Where is Wall Street? Where are the big banks? I want to be trading with them, and I want to know where their orders are. Well, what Wyckoff did was he created the idea that traders and investors should consider that a market was being controlled by a single entity. If we think about it as a single entity, then we can kind of think about it very simply. I always say, Tyron, we have Cocoa Puff brains. That means we can't contemplate too many things at once, and we need to simplify everything. Some of the smartest people in the world, what they're able to do is they're able to take a super complex concept and break it down so that a grade 5 student can understand that complex concept. And it is so important that Wyckoff was able to do this. He basically said, think of all the price action as one single entity, and essentially the composite man represents the biggest players and the market makers, and it allows us as traders to better understand how potential market manipulation manifests in price action. And this is something that we're always looking for and striving to do in markets. So the next time that you see something like a range-bound market, really consider what is happening in terms of the indications. Is there the law of effort going on? Do we see a breakout of either direction? And what does that mean if market retraces back in after a breakout into that range? This is something I think most people underestimate when it comes to Wyckoff, Ty, and it's the most important concept of it all.
Yeah, no, most definitely. Understanding the area and knowing and really wanting the market to do a particular thing is the most important thing there. Not understanding what is actually happening is the biggest enemy in trading. So a lot of people say a flat market can't do anything. You have to wait for it to move. A flat market is actually telling you what is actually happening in that area if you understand it and apply the volume that we've talked about and some of these theories, because it really is trying to tell us something. It's telling us what it's about to do. We just have to know what it's. We have to know that it's actually happening. That's really the most important thing.
Yeah, we need to wait for that activation. Patience is the key. So it brings us to another concept. And this is the one that I get asked even more than anything else, which is how do large institutions actually place orders? How do big banks actually get into market positions? And do we need to change our thought process when it comes to big bank institutions placing orders? If we're a scalper or a day trader, can we take advantage of this type of entry? So we'll be discussing here basically how markets actually move from price to price, how institutions actually enter positions, and then, of course, naked price action trade sequences. How can they help us potentially understand markets better? And I think this is the thing with day trading and scalping. We really need to have these naked price action trading sequences. So, Ty, when it comes to understanding where banks place orders, was this something that you knew straight away in markets, or do you think it was something that we learnt over time?
Absolutely not at the start. I think we had all sorts of problems really identifying these areas, and we were certainly ones, very early on to be falling into all of the traps of actually not understanding where these orders are placed. And look, a lot of it's nothing to be ashamed of either. I think most traders, when they first start out, if they haven't been educated correctly in the markets, are going to make these same mistakes, because it's very, very it's very hard not to be honest, because it's not obvious in the first instance if it's not explained properly. I wish, Tom, that we had webinars and videos like these actually showing us how to do it. It would have saved us a lot of money and certainly a lot of account blowing up, because it's a very, very important concept. Because look, let's face it, as many retail traders would probably understand, or we make up a very, very small part of the market, really. Like when we're looking about how volume works and how markets really move, we can only participate. We can't move markets as retail traders. So understanding where the big orders are placed and how they work is extraordinarily important, because it allows us to participate rather than try and move. We don't need to move the market. We just want to participate in the movement, don't we?
Yeah, we just need to participate in the right area of the movement. And I often hear big investors and $billion fund managers talk about, I just want 2/3 of the move. Just give me 2/3 of the move. That's all 100%. I'm happy with. It's usually, I think that's usually how we slice the pie. So how do we catch a 2/3 of the move? Well, again, we need to understand where periods of accumulation are created and periods of distribution are created. And more importantly, what actually changes a trend? What actually begins a trend? So today we'll discuss first time frame changes of trend, one of my favorite topics. So markets usually look like this, Ty. They have an accumulation, they break out, they go into what we call the markup phase or the two-third phase, and then often they'll enter into distribution or what we call excess. And most modern day trade analysis techniques look something like this in terms of theory. But how do big traders actually place trades? Well, this comes down to when you think about a big trader, what are they? They are a huge institution with billions of dollars to get into that market. If they're going to trade the Australian US dollar, for example, they're going to need to add positions over time. They can't just go, oh, $1 billion into the market. It's just not going to accept it straight away, or even more. Maybe they have to add $10, $15 billion position. They have to do it over time. And this leads to a lot of manipulation, doesn't it, Ty, in these markets?
Yeah. Yeah, absolutely, it does. And people think that, look, a bank is not going to go on and place an order at a particular price and throw the entire ball and chain at it and say, this is the price that we're going to get it at. It can't work that way. That's going to cause all sorts of blocks in the market. It's going to have, it's going to force lines similar to bank intervention. If that happens, you're going to have bank interventions everywhere where price can't get past a particular point because it's accumulating a particular position. That can't happen that way. But there is a fair price that they're after. And what they do, we can see here that we've got three different levels of where or what would be acceptable. We've got the three different levels of what a fair price would be, what a really attractive price would be, and what an acceptable price would be. And this is why traders, banks have big traders working for them, because it's not as simple as actually just placing that one trade. You hear all the time that banks have big amounts of traders doing all the trading volume. If they were placing only one trade, they'd only need one trader, right? So that's not realistic. That's why they've got so many different traders working for them, placing these smaller orders, or what we would consider big orders, but obviously small orders for the bank, to build a position. And this is exactly what they're doing. We can see this in this diagram here.
Yeah, so as the price approaches 72, they might think that's a okay, acceptable price, as you mentioned, and they will begin a purchasing spree at a lesser amount. As it enters into fair price, they'll increase the amount, and if it enters into cheap price or a very good price, they will usually accept even more of those orders, so they'll place even more of them. And why this is such an important sequence is when you think about it, this is often what happens. As it goes back above the acceptable rate, they stop purchasing. And therefore, people that were day trading and getting involved in that trade, they might start to sell their positions, and it drops back down into the fair price, the acceptable price, and possibly the cheap price. And what this does is it builds that structure. And most people that are probably watching this video right now don't really think of markets this way. They don't think of actually how these big institutions actually enter into the markets. And what you're looking for often at the bottom of these cheap areas is wicks. And when you see wicks, you'll notice they hold the key. Wicks hold excitement of the market. So, often when we learn technical analysis for the first time, Ty, we learn something about a pin bar or a hammer. Yeah, it's a great entry criteria, but in the right area, it's more powerful. And that's why we look for price like this. And we start to understand that when we see sideways market action or channels, as many people call them, or demand or accumulation, doesn't really matter. Effectively, what we're looking at actually is a large institution entering positions in a methodical way at different prices with those little snippet areas. And it's such a great way of simplifying price. And I got taught this, I guess you would say, from a pretty big fund manager. And they basically said, this is the way that we would enter in. And it's a great way, I think, of conceptualizing a fairly complex building strategy over time.
Yeah, most definitely. And I think understanding those candles as well, that they are very, very relevant in those areas of accumulation, but really in the middle of nowhere, they're really not worth anywhere near as much weight. So I think it's very, very important to understand these areas, although you might say, well, what do we do with them? Understanding the candles that are happening in those areas and the price action, which is what we're talking about, is very, very important, because price action in the right area is extraordinarily useful to actually place a trade. Whereas, it can be a little bit less important if it's in the middle of nowhere, really. And we do see that sometimes.
Yeah, so people like Wyckoff kind of came up with schematics or systems around these accumulation and distribution areas. He said that if to build a position often takes kind of spikes of zones to effectively trap people into the wrong positions. And then they build liquidity. And then, of course, they push off in a direction. Remember, it's your job as a trader to recognize these traps. And therefore, when it pushes off into the right direction, take that 2/3 movement. That is usually the way you're looking at it. So we mentioned that there are price action sequences, and these are the ones that I think most people make mistakes on. Here's a basic trend, and the trend's coming down. We've got a low, we've got a high, we've got a lower low, we've got a higher high, we've got a lower high, we've got a lower low, lower high, lower low, and then suddenly we make a higher high. Now, when this happens, we break the previous peak, and effectively we change the trend. This is what we call a first time frame change of trend. And most people don't look at it this way and don't understand it in the markets. It's such an important aspect of naked chart analysis and price action analysis. If we go over and we think about it, if a market structure looks something like this, and then it breaches through, what it's done is it's in essence broken through the orders that were placed here that got pressured down. And therefore, it's ready to move to what I call the next level of equilibrium. This is what we call a first time frame change of trend. And around this price, markets should remain bullish, and pullbacks would usually be met by bull demand. And it's something that usually is the first way that price action does change. A little bit of an example here, Tyrone, is this one, which gets a lot of people caught off guard. We often call this the lightning bolt method. That is a low, a higher low, and then a higher high. And it is a very good way of looking at swing trade in particular and investment entry levels. But when we're dealing with scalping and day trading, we've also got to pay attention to the left-hand side. We need to take out that previous peak. Once we've done that, we've taken out the orders that were placed there that lead to a sell, and we effectively can move to the next level of equilibrium, which in this case would most likely be that previous peak. So the point from here to here becomes more likely. And this is where we get back to that 2/3 analysis. So such an important concept, understanding naked price action sequences. We've got some here on the charts, and that's something that I would always break down for scalpers and day traders in particular.
Yeah, lightning bolts are extraordinarily important, but understanding where they are and why they're forming is just as important. And like you say, if we're not taking out the previous peak or the previous trough, is it really a lightning bolt? People can be very, very creative, Tom, when they're drawing the lightning bolts that we talk about. So it's very important to make sure that they are actually breaking the right zones, because it's one of the most important parts of actually price action, especially the naked price action that we're talking about. When you're looking at naked charts, it's extraordinarily important to understand the lightning bolt effect, because the higher highs and higher lows and lower highs and lower lows are the real benchmark for actual price movement. And the levels that they're taking out, being the previous highs or the previous lows, are really the clue that it's giving us that the momentum has truly shifted, and that 2/3 movement that we're trying to get involved in is actually in play.
So markets often look a little bit messy. You know, theory is very different to, I guess, the practical application. It's kind of like when you go to university, Ty, and you learn a lot, and then you come out into the workforce and you're like, what am I doing? And everyone's like, oh, you're that newbie that has all the theory but doesn't know the understanding just yet. We've all been there.
Screwdriver one. Yep.
Yeah. Yeah, the left-handed screwdriver, exactly. So that brings us to a topic that is near and dear to our hearts, which is, how does market structure actually work? You know, what is it when we're looking at markets and we're looking at naked chart analysis? How do we understand the squiggly lines on the screen in a better form? So if it looks something like this, how do we interpret something like that? Well, today we discuss market equilibrium, the laws of supply and demand, and then, of course, using naked charts to recognize those areas of equilibrium. So first up, I want to discuss the idea of supply and demand. Now, everybody probably is aware of supply and demand, but do they know why it works and why it actually forms? So Ty, how important is it to understand these particular concepts of supply and demand? I mean, it only happens when basically big players play the game, isn't it? We're small fish. We can't push the markets like these guys can.
Absolutely. And this is why it's vitally important to understand these zones. And look, yeah, changes in supply and demand only happen when the big traders buy or sell. When price falls, we're going to see a different form of market. And when price rises, of course, it's going to be the same. We have not caused that. And I think it's very, very important to understand that. We are not, as retail traders, which the majority I can imagine will be, are not causing the markets to rise or fall. It is the big players that are doing that. So when price falls, supply outweighs demand. Retail traders are the small fish, like we said. So we cannot make the prices rise or fall. And I think a lot of people, we probably realize that. I think at the start, we don't when we first start out trading. But I think in time, when you do trade for a little while, you do realize that we're not actually making the markets move. So it's really straightforward like that. In Forex, commodities and stock markets, I was actually unreading that screen. It's really the same. What we're saying is the big banks and institutions can never place their full position. So they are going to place small amounts of movement. Sometimes we look at that and we say they're market traps, or we call them bear traps or bull traps, or false breakouts. Look, sometimes you can fall into that trap if you don't really know what you're looking at in these particular zones. You can certainly find yourself falling into those traps. Are they set for the retail traders? Well, perhaps, but all we're doing really by falling into these traps is really highlighting the levels that they're buying at. Don't forget, they're not buying at one price; they're buying at a series of prices. And what we consider traps are those prices actually falling into those places.
So when we're understanding supply demand, it looks something like this on charts. Often you'll see charts being drawn where we've got trend ups or markups, and then we have distribution events, reaccumulation events, accumulation events, and they really just are demand and supply. An accumulation event is demand once it breaks out and up. It is not known as demand until we see that breakout of the upward side. For a supply, it takes the market to break down for us to know that that was distribution or a supply event. And because we know that there is market orders at these levels, what we can do is we can figure out that these are market equilibrium points. And this brings us to a very important topic of supply and demand. We need to know where market equilibrium points are so that we can potentially trade off those in the future. Take this example, for instance. If we look at this example here and we look at the left-hand side, what you'll notice is that there is a lot of market structure that leads into a huge breakout. And then there's an obvious market structure here. And then that leads into another massive breakout. When the price comes back down to this level, what happens? Well, price is met by buyers. And in essence, this whole area here is actually incredible demand. And what that leads into is buying, 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 and then eventually the trend actually continues on. And this is what we call basically a rally, a base, and a rally. And when the market comes back down to these base levels, we're interested in potentially looking at opportunities. Whether you're a day trader, you're a scalper, or you're a swing trader, these areas can be incredibly important. And that's because they're returning back to market equilibrium. So this is a very, very important aspect of markets. Also, we know about the fact that we've got supply up on the top-hand side. The markets have sold this level before. So therefore, if the market comes back to this level, we can guess that there's probably going to be sellers around this zone. Another important aspect of it. So, of course, supply zones are the backwards version of demand. Basically, they represent points where banks and instos have placed significant numbers of sell positions instead of buy positions, and they end up creating excess supply, and the result is prices reverse and move lower. They're effectively like the resistance level of supply and demand, and you'll see some overlap often between supply and demand zones and resistance support zones. So if you're somebody that comes from that backing of understanding support and resistance, then this is really kind of like a nuanced way of doing it. And what you're trying to understand is market equilibrium. So very important to understand both supply and demand. But then when we're in the charts and when we're in the actual market action itself, how are we going to better understand where we might want to actually be placing? Well, here's an example of a drop, a base, a drop, and then a return back to the supply tie. This is pretty much one of the biggest trades, isn't it?
It is, absolutely. And look, I think you bring up a really good point where, when a market is in equilibrium, this is exactly why not knowing whether it's actually supply or a demand zone before it actually breaks out is the very reason why we don't try to preempt what the market's going to do until it actually does it. And it goes a long way to say why patience is so important in trading, because realistically, yes, we can see the market bouncing between levels of highs and lows, but we don't really know which way it's going to break. And a lot of people make the mistake of trying to identify a break before it happens and thinking, well, the market must go up or the market must go down. We don't really know whether it's actually a supply zone or a demand zone until it actually breaks in that particular direction. And this is where you really don't want to just be trying to preempt or guess the direction because you have a gut feel. The market action is what you really want to see. And then when it is identified, it makes a trade like this that we can see on the screen very, very simple, because once that supply zone has broken down and it retests it from below, as you can see here, a lot of people, if you didn't know the supply zone was there and you weren't aware of what has happened on the left of the chart, you may be tricked into thinking that this market's going to go long and we're looking to go to brand new highs. But in reality, this is one of the places that we're looking to sell, because this has already been identified as an area of very high transaction. So it's really telling us what we need to know, but probably highlights the fact that, you've got to look to the left of the chart, don't you, Tom?
You always must look at the left. We're looking at we try to find equilibrium zones, and we understand that when markets return back to those equilibrium zones, or in this case supply, there are orders that were placed there that led to a sell-off. So why would you not believe that there is large institutions that are going to be excited around these levels, Tyrone? And this is the thing. It's about understanding that institutions placed orders there before that led to a certain action, the effect, and therefore if the markets go back to those levels, we could be very confident that there is probably going to be some action around those zones. And you can see how it differs from standard support resistance theory. That would be that this is support, and then the market breaks the support. And if it comes back, you'd be looking at this zone here being the resistance. So therefore, you'd be looking at selling this zone. While it did sell from that level, you'll notice that the biggest sell comes off this area up here, which is where the market's placed the vast majority of the orders. And that's why we also want to be understanding volume, equilibrium, and some of these points here. Now, which are the best trading pairs for supply demand theories? Well, in general, we want to be looking at highly liquid pairs, Tyrone, and it's always going to be the biggest pairs that retail traders generally trade. Why? Because in essence, with supply demand theory and in Wyckoff theory and everything like that, we are really taking advantage of manipulation of markets that tend to trap us. And that's what we want to be doing. We want to be reacting to those manipulations.
Yeah, you do. Look, low liquidity markets can be very, very problematic when you're trying to set up any sort of plan, whether it's technical analysis, whether it's fundamental analysis. Very low liquidity can be very, very problematic. So when you really concentrate on the bigger base pairs, and there's plenty of them too. Like, we're not really limiting how you can trade. There are literally 20 or 30 currency pairs that we would consider fairly liquid, wouldn't we, Tom? And then you've got your major indices. You're never going to run out of things to trade. And then don't forget, with every trading pair or every instrument that you're trading, there are different time frames that you can do. So if it's not really moving on a daily or a 4 hour or an 8 hour, you can go down to a 1 hour and actually see these setups happening. So it really comes down to how you want to place your trades, but you're not going to be limited by focusing on high liquidity. And remember, though, that low liquidity can be very, very problematic. And a lot of people want to try and get an edge, and I can understand that. But realistically, sticking with the bigger ones is going to give you the most amount of movement and the most amount of reliability, I think.
Okay, so what time frame is best for you when thinking about supply and demand theories? The question really comes down to what type of market you're trading and also where you're from in the world. Generally speaking, the best session for currencies would be the London pre-open and then into the US overlap. For something like gold, potentially the Asian session and the London Open can be very good. For somebody that wants to trade indices, usually the US session is incredibly powerful. So it really comes down to what type of instrument do you want to select? And then more importantly, we then need to understand that trading around the opens is going to be the largest chance of a false move and therefore a trap being set that will often go off in the other direction. So next time you're looking at a market and it goes one way and then it goes opposite straight after that, what that is it's a liquidity trap. And actually, it's in essence generally a market coming back to a level of equilibrium. Okay, Ty. So I guess that brings us to some Q&A that I'd like to do with everybody right now. And we'll also jump into the charts and we'll take a look at some real life kind of examples in the markets of these concepts. Now, we do have some questions coming through. Please feel free to ask more. And the first one here has to do with, I think it's Dailies 86, and it says patience and choosing to wait to see the market's intention is one of the most challenging aspects to learn. Choosing to wait and react instead of guess and hope has been helpful in my trading immensely. Yeah,
100% agree.
yeah,
Very, very.
I mean, could I have said it better? Absolutely
No,
not.
no.
No, you're right, and I think the thing is here with patience and doing all of these things is that we must understand that trading is a business, and you wouldn't risk your business by over. Let's say you had a cafe, you wouldn't order something that you don't sell in your cafe just because it was the hottest thing. If your clientele don't want it, you shouldn't order it. Now, in the same case of trading positions, we shouldn't go and trade an instrument we've never looked at before that doesn't have a good technical on it just because everybody else is doing it. We have to stay in our lane. And Tyron and I have found that that is the most powerful thing, sticking in your lane and understanding that trading's a business. Ty, what wisdom words do you have for everybody here?
Yeah, look, you stole my milk bar idea, and
Oh, did
yeah,
I?
and I'll give you that.
Yes.
Yeah, that's one I always use. And look, it is so important. It is so important to treat it as a business, even if you. Yeah, even if you're looking, even if you're just starting out, the reason you're starting out and exploring and dipping your toes in the water when you want to start to trade is to actually change your life, right? You want to actually change the way your income comes in. You want to change, yeah, potentially how and well, how you work, what hours you work. So you've got to treat it seriously right from the start. If you make mistakes at the start because you think, well, it's only a small account, doesn't really matter, I'm only learning, you're going to deploy bad habits immediately. So being patient and like we just talked about, being patient and actually reacting and waiting for markets to do the things that we've talked about today are going to help you extraordinarily in the future, even if you've got a small account. Don't don't just think because you're starting out that you don't want to take it seriously. You'll develop bad habits that you'll find very difficult to break.
Yeah,
Again, yeah, if you're running a hardware store, you're not going to guess yeah, how many things you need. You're going to let the people who want to buy that material come in and tell you what you need, and you'll basically stock accordingly. Trading is no different. You must treat it like a business.
Yeah, I also think it's about getting the reps in, Ty. Now, I might not have guns like you, yeah, but I do, I do the reps. And what this means is that when you're trading a certain business, look at him. Oh, he's showing off just because he can lift 55 kilo dumbbells each arm. That's something that's half my weight. Well, actually, I don't even weigh that much, but yeah, you know what I'm saying. So basically, the key here is that what we're understanding is we need to get the reps in. So whenever you're trading, think about this way. Once you've placed the same trade 40 times, you've generally got the reps in. You'll understand your statistical advantage. This is actually psychologically, you have to do it around 40 times. You'll understand your statistical advantage. You'll understand how many times you win. You'll know kind of a little bit about your variance in terms of statistics. And more importantly, you'll be able to take that trade, even if news looks weird and, something fear and greed take control of your mind. In essence, you're just doing the reps, pushing them out. It's kind of like you go to the gym, Ty, when you first learn a new exercise for the first couple of weeks, you might stumble. A month later, you're like, I'm a boss at this exercise. I could become
exactly
a PT.
What you're doing. Yep. You'll see a setup in the market and you'll say, once you've done it enough times, I know what that setup looks like. I know what it's going to do 8 or 9 times out of 10, and you will trade it automatically. And that's what it is. You cannot buy market time. Market time has to be experienced. But and this is exactly why you don't want to be making rookie mistakes early on if you can avoid it. If you're able to learn it from the start, you'll see the correct way to do it. You'll understand it and you'll place it. Emotion will be completely irrelevant, and that's really important when it comes to trading. You want to keep your emotions at the door and trade what you know and what you see.
All right, so we got Guled here saying, I have a question. Feel free to ask it in the room, man. We will answer that soon. And we've also got Rabail asking his question. He says, please discuss and show some demand supply examples over the gold versus USD chart. No worries. So let's load up gold here, which we have. And what you'll notice is that we have plenty of really good quality kind of supplies and demands on the way down. And more importantly, we've actually entered into a supply right now, which you can see is over here on the left-hand side. This led to a breakout of this particular zone, therefore, and we got a lot of supply, you can see it was initially here. So we had a drop,
You got to put
a
the charts
base.
on the screen, Tom.
Oh, wait. Sorry, guys. We haven't drawn it on the chart. There we go. There we go. We were just on the screen. All right, now we can all see it. So yeah, here we have a chart of gold, and let me restart that. So we've got here a drop and a base, and we have a break of this key level over here, break of this support, and that leads to a drop. Now, when it comes back to that level of supply, you can see the way the market's interacted with that. And that means that there was a lot of orders that were placed through there. Big positions were placed in this area. Over here on the right-hand side at the time of this recording, we can see that the market has made it to this level. When it broke out here, it was highly likely to go here. It's kind of like that 2/3 move. Now that it's here, it could sell off. It may breach it. But if it does breach it, then we can pretty much guess that if the market comes back to this level, because this was such an important level in the past, it could act as a great scalping time frame for us to jump into the smaller charts and look for longs. So it acts two ways in this case. At the moment, it's supply. At the moment, you'll be looking at it saying, well, there could be some weakness in here. And that's just one of the levels. Another example was a very similar thing, a drop, a base that led to a sell-off. We're not making that prediction. Remember, we don't want to predict. Instead, we want to react. At this point down here, we go, oh, wow, this market sold here and it led to a big sell-off. If it returns back to this zone, there may be sellers. And there were 1 time, 2 times, 3 times, and then the sellers got overrun with buyers and they moved to the next levels. So in essence, that's what you're looking for in markets. And of course, it's happening on all different time frames, but think of the time frames or the markets as fractal. So what that kind of means is you're looking at a 1 hour chart, a 2 hour chart, a 45-minute chart maybe, but you're not looking at a 56-minute chart and a 51-minute chart. And why that's important is because why are we not looking at those charts? Well, they don't make sense to us as humans. But when you start thinking about markets as structure and supply and demand theory and naked chart analysis this way, Ty, what we're doing is we're actually understanding the structure across all of those time frames, and we're starting to look for the orders underneath the system, just like the big banks end up adding in. They like a zone. They're buying that fair value zone at a higher rate than everything else, and you'll be able to see that represented in the price action.
Yep, no, you certainly will. You certainly will. Just reading through some of these questions here. Cabsy, the best time frame to trade for beginners. We always say to beginners that really the bigger the time frame, the more accurate and the more important the information is. Most beginners actually start the other way. They actually go on minute charts and 5-minute charts. They're actually the hardest charts to trade as a beginner. What we would always recommend if someone came out of nowhere and said, I really want to learn how to trade, what's the best time frame? I would always say probably the daily and the 4-hour charts are where you're going to learn the most, because they give you time to actually understand what the market is doing. You don't have to be as fast and as I guess accurate even. I mean, the daily especially gives you plenty of time to get in on trends, plenty of time to identify the zones where it is accumulating and distributing the price action. So yeah, definitely start bigger and work your way down. And then identifying the best time for yourself and how you're able to trade in terms of your lifestyle is really going to come down to, that's down the track. But really, you've got to make the sacrifice at the start, right? Like even if you've only got 1 hour to trade, that actually even lends more to the fact that you should be trading the bigger time frames. And if you have more time down the track, you can go to the smaller time frames then, but certainly start out with the big ones. It's going to help you out a lot.
Yeah, so I think that 4-hour daily, a really great time frame. Set alerts as well. Setting alerts will allow you to potentially then activate smaller time frames. But yeah, that's the way we would be looking at it. Guled says here, how do I determine a trend reversal with price action? Market structure, but I'm not sure of trend reversals with price action. So you're asking, how do you figure out just like a trend reversal? Think about what we just covered when it comes to first time frame changes of trend, the lightning bolt and the break of a previous supply. Or demand. Once that happens, you basically reverse trend. And that, at least on the first time frame, is one of the ways. There's only really 3 ways trends change, and that's actually one of the ways that trends change, and is the most common way that trends change. So I would say that. We've got another question here. Currently, Euro US dollar, and this is from, sorry if I butcher your name here, Imtiaz, I think. I'm sorry if I mispronounced that. And you said here, currently, Euro US dollar pair is significantly in a super bullish trend. I agree. what I noticed is that the price never retraced to grab liquidity. What perspective on this, and how do we manage such scenarios? Yeah, so look, I had euro on it for an example, because what you're saying is basically that we're not seeing the market come back to more, we would say defended zones where we could potentially buy off those and get really nice entry criteria. This is more of a momentum based market that, of course, was triggered through news. So we'll go over to the charts here and I'll show it to you. And here's the euro. And what's happened here is the market broke out. The market obviously changed trend down here, but it didn't really pull back much. So especially on this breakout, just went boom, boom, boom. It really depends on the type of trader you're going to be. If you are a supply demand trader, you will have a hard time getting into this market because it is a momentum based market. Now, that could mean that you have to go to another instrument and trade that instead. It could mean that you have to have a different system for this type of market and recognize it. I generally say stay in your own lane, become an expert of the type of system you want. I'm not a huge momentum based trader. And you know why? It's just down to statistics. Most of the time, markets don't trade like that. But some of the year times they do. Around 3 months of the year, you'll see this type of action. And 9 months of the year, you'll see normal action. And what does that mean? Well, I would rather be able to trade 9 months with my system, Ty, than trade 3 months. And I'm not getting in anyway. So it's not like I'm losing in this particular system. I'm just being patient and sticking in my lane. So that is one way that you can do it.
Yeah, that's right. And if you go to the smaller time frames, you're always going to have opportunities to join in those trends. But I think it is a bit of a different strategy. It's not really a supply and demand type strategy at that point. You've got to be basically taking the trades and smaller pullbacks, understanding how the market is trending. That's really a story for another day. There's no question about that.
In many ways it is, yeah. I'll just quickly say one last thing about that. If you do end up getting involved in these markets and you buy them, the reason markets cane everybody in long term is because then you get conditioned to do that all the time. Remember, 9 months of the year, it's not doing this. So if you then say, oh, I'll just buy the breakouts, and you're not disciplined in your trading, you'll get your ass kicked trying to do this system later on. So just remember, unless you can read momentum breakouts and you know they're coming, very difficult to create replication of this unless that's your system.
Know the market that you're in is probably the thing that is most important there. Know when a trend market is happening and know when that consolidation is happening as well. So, and Dean just says, great content, guys. Thank you, Dean. It will be on your YouTube, absolutely. You can watch it. You can watch the replay on this link immediately. You can watch it as many times as you like. So there is a lot of information that we've gone through. So yeah, most definitely watch the replay as many times as you need to, because it's very, very important. It is an advanced webinar, this one, but it shows a lot of important aspects that bring together what we look at on a daily basis. So that pretty much wraps up our questions, Tom. So look, thank you so much for joining us, everybody. We appreciate your time, and we hope we've added some value to your trading. And really, like I said, pop any topics. We're doing these every week now. I'm not sure if you're aware, but you can see they're scheduled weekly, not fortnightly. So there's different topics every week, but always feel free to let your Pepperstone customer service people know what really interests you and what you'd like to see more of, because we are here for you and we appreciate you've given us your time. So thanks again, and we look forward to seeing you next week.
All right. Bye, everybody. Next week, we cover another exciting topic. So make sure you're there, same time, same place. We'll see you then. Bye for now.